Hello, I'm Mark Starosciak, Managing Partner with Infinium Investment Advisors. You've tuned into our market update. Look ahead for 2015. As a reminder, anything that we talk about today is purely for informational purposes. It is not a recommendation to buy or sell securities or follow any investment strategy. We don't provide tax and legal advice, and always consult your own financial advisor before making any investment decisions. All right, 2015. We think there's a decent chance this year is going to be fairly mushy. We've had an extended bull market that's been running since the low in March of 2009 after the financial crisis. And we think there's a decent chance that that could be over. And what does that mean? Does that mean we're going to see a 20% drop, a big bear market? No, not necessarily. But we do see signs in the marketplace that the bull market, straight up with little volatility, is sort of coming to an end. We think the cross currents are very real. So, from a short-term view, we continue to see volatility pick up. That's actually a good thing. That signals a more normal market. We've been sort of lulled into this low volatility market in the last 5, 6 years, and it's just not normal. So, see it's normalizing. Uh, on the intermediate term as well, and we'll show this in the next slide, the cross currents are sort of catching up to this market and stopping it in its tracks from just this straight ahead onward and upward. So we see the intermediate term as could go either way at this point. We certainly could continue higher. Market hasn't been damaged enough in the last several weeks or months to warrant us to consider that. But it's a fairly neutral, could go either way, and we'd say the long term as well is somewhat in jeopardy of giving up that bull market run. It's just unclear right now. So we would say we're sort of in a very neutral market, but markets are signaling a change potentially. And the reason we say that is various parts of the market that we watch are changing. So volatility is picking up. In this yellow line, we can see that. Bonds, which are typically a safe haven that investors flock to when times are uncertain or the economy is turning down, that has come up here very recently. And again, remember, bonds and interest rates move opposite. So when interest rates fall, bond prices move up. No one thought that could happen, very few. And indeed, that is what's happened here, especially this year. The S&P has been neutral to down. It's been a very hard go of it at the beginning of 2015. Very different than the last several years where the market has just sort of taken off and kept on pace. So we're seeing that pace slow down, and it's sort of neutral to giving up a little bit to the downside. Gold as well, we're seeing gold finally catch a bid. We saw a 20-30% drop in gold from the high in August of 2011, but gold now is finally looking like the trend has turned back up. And viewers of our video blog here will know we were very bearish on gold for a long time as folks were enamored with it. Well, when you see a 20 to 30% drop, that's usually enough to get people uninterested. And usually that's the time when it makes a lot more sense. So we're not recommending gold necessarily, but we think the trend is absolutely reversed on gold, and it looks fairly attractive here from a move up standpoint. So the question then is, well, what do you do if the bull market is over? And the question we ask is, well, are there any investments that can go up when the markets are flat to down? And the answer to that is clearly yes, if you know where to look. So an area that we've used quite a bit for clients over the years is what we call alternatives, or liquid alternatives is sort of the new buzz phrase. But these are investments essentially that can go up no matter which way the markets are going. They're sort of unrelated to what's happening in the stock market. There are several listed here. The one we want to focus in on is what we call managed futures. Again, I want to reiterate that this is not a recommendation. These can be sophisticated. Always talk to your own financial advisor. Give us a call if you want to learn more about these investments and how they work to see if they're right for you. But don't run out and buy these in your portfolio without doing the homework. So when we look back for the last 15 years or so, we see U.S. stocks averaged about 4% a year over that time with a max drawdown of 51%. You had to put up with this massive bear market that happened during the financial crisis. Managed futures did actually a bit better, 5.5% average annual return. But look at your drawdown. It was only about 16% was the worst that you had to put up with. So, that is absolutely a trade-off that we are interested in exploring. Additionally, we look at what's called correlation. So how do managed futures correlate to the U.S. stock market? 0 is basically perfectly, no correlation. So a minus 15 we'd consider that a very low correlation, meaning that you have true diversification with an investment like this in your portfolio. The problem lately is that they've struggled. And, when you look back at these are, again, different types of liquid alternatives. Over the last 5 years, very lackluster, 2, 3, 4%, nothing to get really excited about. And have really been a drag on portfolios when the stock market's up double digits. However, we've seen, and this is a chart on managed futures, we've seen them turn up. And this gets back to this idea that volatility is picking up, we're getting a more normal market. And these alternatives are now starting to work again. Certainly they could turn off at any time, but right now they are working very well. And last year, 2 types of managed futures providers, the diversified traders, so they use a variety of ways to achieve their performance, they were up double digits. And systematic traders, ones that use the big computers and algorithms, those guys were up double digits as well. So bottom line here is there is something that's always working. What we'd like you to do is to get out there, examine your portfolio. If you don't have the means or the interest, find a professional, seek a second opinion. Talk to your current advisor. But you want to assess how much of your portfolio is built on a rising stock market. And then if you don't have much or you don't have enough, consider those investments that can go up, even if the markets are in a bear, bull, or neutral. With that, I'm Mark Starosciak, and we will see you next time.